I want to shift over, though, because as we're talking about the sell-off in the crypto space, we've been watching a similar sell-off, albeit a little bit more muted here for the broader market, as we see the Dow off nearly 1%, and questions around whether or not this kind of interplay is going to exist, given the way that some funds have levered themselves toward the crypto space. Tech, though, not necessarily taking it on the chin like it has in days past. And for more on where we're at in this state of the markets, I want to bring on our next guest, Mark Luschini. Janney Montgomery Scott, Chief Investment Strategist, joins us right now. And Mark, I mean, when we're looking at it, we've been talking about, inflation fears, crypto risks, a lot of different things. But when you back up and look at where we're at, I haven't even talked about the Fed here, and it's noon. Talk to me about what you're seeing in the market right now and the jitters, what you make of those.
Well, I'm not making a whole lot of it at the moment. I mean, obviously, the pullback here has gotten a little deeper over the last couple of trading sessions, not necessarily threatening technically important lines of support. We bounced off it, in fact, off an intraday basis today. We'll see if it holds or whether we need to do a little bit more work on the downside to kind of flush out some of the sentiment that's gotten a little bit perhaps overly exuberant relative to this advance that we've had so far this year. But I mean, in the context of the market, we're still up over 8% on a year-to-date basis. The economic conditions fundamentally are still very supportive for stock prices. We had once again, a little concern here recently about inflation. Obviously, the big risk at the moment is that it's not so transitory in nature and that it persists at a more elevated level, even as we lap the effects of a year ago. And that obviously the jury is still out on. But in the meantime, when you look at the economic underpinnings, which we're seeing economic growth, the Atlanta Fed GDP Now survey just yesterday came out with a print of better than 10% growth here annualized in the second quarter. We think it's likely to probably peak out perhaps in the second or possibly third quarter this year. But nonetheless, any kind of deceleration from there is likely to stay very elevated as it coincides with the reopening of the economy more fully and uniformly than what we've seen heretofore. So I think earnings estimates continue to migrate higher, and that's again, a fundamental support for stock prices. So obviously, as we've now entered the second year of the bull market, where we've had a lot of good news baked in, the market becomes more vulnerable to be sold off, almost catalyzed by next to anything. And so I would expect more volatility as we go forward. I would also expect returns to be a little harder earned than what we saw in the last 12 months or so, but nonetheless positive.
So, Mark, it sounds like you think that the sell-off that's tied to at least inflation jitters are a little overdone. I mean, if that is the case, where do you see the opportunities?
I still think the opportunity is where we've been now for quite some time, and we became much more bullish on the whole pro-growth, pro-cyclical phase, meaning obviously the cyclical sectors like energy, materials, industrials, and financials in September of last year. And while we've seen a rotation back to large cap tech, kind of back in that mid-March to mid-April period, then a reversion back out of that rotation back into these cyclicals. And now, of course, everything's selling off almost uniformly over the last couple of days. We think it'll reassert itself. We do think that we're going to continue to see, as I alluded to earlier, very strong and positive economic activity spilling over into next year. We do expect to see interest rates to grind modestly higher, and more likely than not, inflation to achieve at least the Fed's goal of breaching that 2% handle and staying above it for some period of time, if not necessarily hyperinflation in the next 12 to 18 months. We think the economy doesn't support that at this juncture, but still, that's a very favorable setting for global cyclicals for that matter. So we remain long those sectors, and actually, as a consequence of the pressure we've seen and continue to expect to see in the dollar, think overseas, particularly European equities look very appealing at this juncture.
Mark Luschini, Janney Montgomery Scott, Chief Investment Strategist. It's good to talk to you today.